Hey guys, welcome back to my channel, The Black Accountant. If you haven't already done so, go ahead and like, subscribe, and leave a comment of any kind of content you want to see going forward. So today I wanted to talk a little bit about the American Opportunity Credit, which is a tax credit that you can get of up to $2,500 for education. So typically speaking, this is a credit that you can only get for 4 years, and it's for the first 4 years of your post-secondary education. So what that means is from the moment you decide to go to community college, so the first year that you start taking classes at a community college that's accredited or a university that's also accredited, then that begins the countdown for this credit. So let me give you an example. If you are a junior in your third year and you've just transferred to, say, UCLA from a community college, and this is your first time filing taxes, you've already completed 3 years of your post-secondary education, the third year being the current tax year. So you would only be able to claim this credit for 2020 and for 2021, only those 2 years, because you'd have your third year in 2020 and your fourth year in 2021. And this specific credit requires a couple of things. So you'd have to have a Form 1098T, and let me show you what that looks like. So on this form, you're going to see the Form 1098T, which gives you the filer's name, which is going to be your school. It's going to have the address, and it's going to have the school's identification number. Student tax identification number is going to be your social security number, your student name, address, etc., etc. But the thing that we're going to be concerned about most right now is boxes 1 and boxes 5. So box 1 is your qualified tuition and related expenses. So this is all the money that was billed to you, or sorry, all the bills that were billed to you by the school, and all the money that they receive from you, including scholarships. And scholarships or grants is going to be however much of this amount was considered a grant, like a Pell Grant, a Cal Grant, a scholarship of some sort that the school received. So what you're going to want to do is subtract the smaller number from the bigger number. So here we have $7,000 in this example for qualified expenses and $3,000 for scholarships or grants. So we'll take $7,000 and subtract $3,000, leaving us with $4,000 of qualified tuition and related expenses. So what we're going to do with that information is go back to this page. And with that $4,000 that we have $4,000 of qualified expenses. So what the IRS is going to allow us to do is get a credit out of this. So we're going to break down this $4,000 into two $2,000. And the reason for this being is to determine how much credit you can get. So the IRS allows you to, out of this $4,000, which is probably going to be the maximum amount of qualified expenses that we can have, $4,000, the first $2,000 is automatically a credit for us. So far right now, we've already qualified for $2,000 of this $2,500 credit. Now, the second $2,000 here, we're only allowed a credit of 25% of this $2,000. And these are just the IRS's rules. So 25% of 2,000 is going to be $500. So the maximum credit that we can get from this American Opportunity Credit is going to be the $2,500. And what this does, a credit is literally a dollar for dollar reduction in the amount of tax you owe. So if you're confused between deductions and credits, you can go back and look at my previous video where I talked a little bit about what the difference is between a deduction and a credit. So what's special about the American Opportunity Credit is that up to 40% of this $2,500 credit is refundable. So let me show you what I mean by that. So 40% of 2,500 is equal to $1,000. So you can actually receive up to $1,000 in extra money, as in money that goes back in your pocket. So if you have a refund, you're going to get this $1,000 back. But let's say you ended up owing tax of $600. And you qualified for this $2,500 deduction, or sorry, this $2,500 credit. So we're going to subtract the $600 from 2,500, which is going to leave us with $1,900. Hope you're following along so far. So like I said, out of this 2,500, we're going to cover as much of it as possible of the tax. Since the 2,500 is enough to really get rid of the whole $600 tax liability, now we owe zero tax, right? So now that we owe zero tax, we have $1,900 left over. So the IRS allows us up to 40% of a refund. 40% refund, which is $1,000 of whatever's left over. So out of this 1,900, 900 of these dollars just disappear because they already did their job. It helped reduce our tax liability. Our tax liability is now zero. So that $1,000 out of this 1,900 is going to go back to our pockets. So we're going to get paid this $1,000. And this is in the case that you have qualified expenses, $4,000 of qualified expenses. So what the IRS deems as qualified expenses would be textbooks, supplies, things required of you in your syllabus. So if you wanted to expense a computer, you can only expense that if it's strictly required by you or by your professor, in your syllabus, and it's required for the class, you only use it for school. And if you ever get audited by the IRS, that's something that you would need to provide proof of. So don't try to just go ahead and expense everything possible. So let's go back to the form. And as you can see here on the form, let's reverse the scenario. Let's say we had $3,000 that we paid, and we were assessed a scholarship of $7,000. So now we're going to subtract this $3,000 from this $7,000, leading to $4,000 in grants. So if your grants left over are from a scholarship that had stipulations that it only be used for class materials or school materials, then that $4,000 isn't going to be taxed. If it was regular Cal Grant, Pell Grant, FAFSA money that was just given to you in your pocket and you can do whatever you wanted with it, which is $4,000, it's going to be considered as ordinary income by the IRS and it's going to be taxed. So then in that case, you actually would not qualify for this credit and you would actually have income that's considered additional income and is going to be taxed at your regular tax rate. And again, for the rules to qualify for the American Opportunity Credit, just to go over it one more time, you can only claim this credit for a total of 4 years. You have to be a student or have to have been a student during the tax year that you're claiming this, and it has to be your first 4 years of post-secondary education. You cannot have a felony. If you're older than 24, you automatically qualify for the refundable portion of this credit. If you're under 24 but over the age of 18, you could qualify for the refundable portion of this credit if you provide for more than half of your own support, you pay your own rent, you live in your own place, etc., etc. And that you did receive this form. So those are the main stipulations. There could be a couple more, but for now, that's just the general gist of this specific credit. Let me know in the comment section below if you have any further questions or any other content that you'd like to see.